Welcome to today's podcast. I am Melissa Ngabire, your host for today's episode. And today we're diving into a topic that is rapidly reshaping boardroom conversations, regulatory expectations, and investment decisions across the globe: climate risk and its impact on financial stability. Climate change is often discussed as environmental issue, but increasingly it is being recognized as what it also is: a direct threat to financial systems, economies, and long-term business viability. From extreme weather events disrupting operations and supply chains to rising temperatures shrinking water sources that entire industries depend on, to regulatory shifts accelerating the transition to a low carbon economy. Climate change is influencing how capital is allocated, how risks are priced, and how institutions are governed. And for financial systems, including here in Uganda, the implications are real and they are already unfolding. Today's conversation explores how climate related risks, whether physical, transitional, litigation risks, can affect bankers, insurers, investors, and ultimately the broader economy. We will unpack why central bank and regulators are paying closer attention, what organizations should be doing now to strengthen resilience, and why disclosure frameworks are becoming central to financial decision making. Whether you're a board member, regulator, financial executive, investor, or business leader, this discussion is designed to equip you with clarity, not complexity. So let's get into it. My guest today is someone whose work sits at a very important crossroad where financial reporting meets sustainability and climate risk. Michael Mayanja is an audit manager here at Grant Thornton with over 6 years of professional experience spanning from some of Uganda's most critical sectors: financial services, insurance, to oil, gas, energy, manufacturing, and agriculture. But what makes today's conversation particularly relevant is that Michael also works closely with organizations to identify, manage, and report on ESG and climate related risks, helping boards and leadership teams integrate sustainability into their financial decision making. Michael, it's wonderful to have you here today. Thank you for making the time.
Thank you, Melissa. Glad to be here today.
All right. So, to begin with, for someone in our audience who might not understand terms like ESG and climate risk, how would you best describe it to them and also how it impacts them personally?
Sure, Melissa. Let me put it this way. Climate risk and ESG sound like big technical terms, but strip them back, and they are really asking one simple question: are the things we are investing in, lending to, and building our economy around, are they sustainable? Because when climate change disrupts the way we live and do business, it doesn't just affect the environment, it affects prices, it affects jobs, it affects whether your bank is stable, whether your pension holds its value, whether the business you build survives the next decade. ESG is simply a way of measuring whether organizations are taking those risks seriously, environmentally, socially, and how they are governed. So even if you have never sat in a boardroom or read a financial report, if you earn a salary, run a business, or have any stake in this economy, this conversation is for you.
All right. So, now that we understand why this matters, could you please explain the impact climate change has on financial systems?
Melissa, at this stage, we cannot actually identify the quantified impact, but we can at least identify potential challenges of such impacts. And they are typically classified as physical risks and transitional risks. We still aren't sure of exactly what the impact of climate change will be on the financial system, but the direct impact of climate change will be on the operations and financial results of corporates. And this will in turn affect the investors, insurers, lenders who rely on these results. TCFD defines categories for climate related risks and opportunities to corporates and put the risks into two possible categories, which are transition risks and physical risks. First, transition to a low carbon economy will mean huge changes in regulations, technology, and market demand, which companies will have to react to in a timely manner. Second, climate change is causing more and more severe weather events, which can have big physical impacts on a company's operations and financial results. However, the company can also find new business opportunities in renewable energy or helping people cope with the physical effects of climate change.
All right. I would just like to follow up on something you mentioned, physical and transition risks. Could you please explain to us the differences between these two?
The physical risks are direct impacts of changing weather and climate patterns on assets, operations, and people. They arise from actual physical events or gradual environmental changes and are categorized into two: the acute physical risks and the chronic physical risks. Now, examples of acute physical risks are like floods, the droughts, the wildfires. You've heard of the wildfires that happened in California. So all those are just acute because they don't happen to prolong their stay or their impact on the environment. Whereas the chronic physical risks, these they tend to prolong their effect, and their effects are normally irreversible. Like, for example, rising temperatures, when there is water scarcity, and probably the change in rainfall patterns. And you have seen so many uh, countries and the different areas being affected by these risks, and these are irreversible.
Oh, interesting.
So transition risks relate to risks that transition us to a lower carbon economy. So now these risks may include like technology risks, because as the world is transitioning to lower carbon economies, there is a tendency of investing in new technologies. Like you've seen electrical cars, the electrical bikes. All this is to avoid the fuel combustion vehicles or cars that normally release carbon dioxide into the environment, that ends up affecting the atmospheric temperatures and resulting to global warming. Probably the other transition risk is around market demand. As people tend to understand the impacts of climate, they tend to change the preference of what they want. So in the future, as the companies are transitioning to low carbon economy, and there's changing technologies, the market demand for some items will definitely go low, and so many assets will end up being written off.
So, for context, and here in our Ugandan setting, could you please explain how this impacts our financial system?
So investors, lenders, and insurers gain clear insights into which businesses are resilient to climate change and which may struggle as regulations, technology, and consumer behavior evolve. For example, we've seen the central bank encouraging banks to invest in companies with low carbon emissions and companies that focus on preserving the environment. The central bank itself has some agricultural facility loans which are offered at lower rates because agricultural activities do no harm on the environment in most cases. Then also, for purposes of better pricing of these risks, reliable climate-related information would enable markets to collectively price climate-related risks and opportunities in lending, investing, and infrastructure decisions. Insurers may be impacted if the premium charged becomes costly in the event of landslides that damage infrastructures or properties insured. Hence, a need for the insurers to integrate climate change in their strategy to better price risks.
So, Michael, why is it important to consider the effects of climate change on our financial systems?
From the perspective of the central bank, which supervises the banks and other financial institutions, generally speaking, we must prevent a systemic event in the financial sector from affecting the ordinary life of the people. So, such a systematic risk would emerge where the financial system is commonly exposed to a certain risk. In other words, if every financial actor in the financial system are largely exposed to one single risk factor, then the financial system will be vulnerable to that risk and could be very fragile in the end. And climate change has such attributes that make it qualified for financial system risk, because it can indiscriminately influence on financial institutions if they are not ready and not prepared for it. This is why financial supervisors endeavor to address climate risk to the financial system right now while quantifying it, which is a difficult task.
Thank you, Michael. Just to follow up on that, I'd like for you to elaborate more for our audience. Why should central bank care?
The central bank should really care about this because of several reasons. For example, the banks are the core companies for the financial system. And for example, if there is any flooding that happens and the bank has customers um, whom they had extended loan facilities to, and these loan facilities were secured they were secured using collateral securities, like maybe land, buildings, and so on. If there is any flooding as a physical risk caused by climate change, this flooding can affect the properties, can destroy the properties, and the values of these properties will tend to probably reduce, or it may also impact the value chain, the supply value chain of the corporates. Therefore, it implies that the loans given to the customers may become non-performing because the companies are struggling and they are not able to ensure that they pay. And if the loans become non-performing, and there's so many non-performing loans within the financial system, this weakens the financial system and it destabilizes the system. So that's why the central bank should care. In addition to that, the central bank itself, because they care, they issued or they published a financial instrument that requires all banks to report on sustainability in Uganda. And also the same applies to our oversight accounting body, that is ISPAO. They also published a roadmap on how different corporates or different companies should start reporting on sustainability and things to do with climate-related matters.
So now that we've looked at the impact and the effects, what can now be done to strengthen the financial system in response to these climate changes?
In essence, the financial system's preparedness to climate change is to be enhanced. Well, to do so, uh, risk identification and risk measurement would be a starting point. The prerequisite for this is the data and information for such identification and then measurement. And this is why the TCFD played a vital role by encouraging the improvement in the level of required climate-related disclosures by the corporate sector. Once risks are identified and properly measured, financial institutions must act to address them by reducing their exposure to risks or engaging directly or indirectly with the risks involved and effectively reducing their threats or enhancing its loss absorbing capacity by building up its own capital. So, in those ways, the financial system could be strengthened against climate change. So, for investors, insurers, and lenders to manage their financial risks, they need to accurately price risks and opportunities relating to each company into their business and into their investment decisions. In order to do this, they need consistent and comparable information from every company focusing on possible financial impacts of climate change. Consistent and comparable information disclosures requires a good understanding of the situation of the company and possible future scenarios for risks and opportunities. If all companies can give investors the ability to accurately price climate change risks and opportunities into their investment decisions, then climate change can be effectively integrated into the allocation of capital across the financial system. So climate change is not just a long-term risk. The effects are being seen more every day, although sudden allocation of capital have their own risks. It's vital for companies to understand the risks that could affect them as soon as possible, and for them to communicate these to investors without delay so that sudden reallocation of capital are not needed.
So, just to follow that up, how else would the financial system be strengthened to mitigate risk or to mobilize capital as we transition into a low carbon economy?
Thank you, Melissa, for that question. Just integrating climate change risk into investment decision is not enough. So investors and companies also need to have constructive dialogue on how to respond to climate-related risks and opportunities. So investors can also use the TCFD recommendation to understand which issues are most relevant for their investing companies. So the more dialogue there is, the stronger the role of the financial system can be. When we say integrating risk into investment decision, we mean, of course, asset managers, but also asset owners. So asset owners have a responsibility to reflect the view of their beneficiaries. But in order to know what a beneficiary wants, they have to actively seek information on their expectations. On the other hand, investors also have a responsibility to make their voice heard on the topic they feel strongly about. such as climate change.
So, I would also like you to elaborate a little more on why investors should care about climate change.
So, climate change is an existential risk for the insurance sector, for say. If you think about it, they underwrite floods, they and fires, and some of other peers underwrite crop insurance. So climate change could lead to premiums becoming so expensive that they are effectively uneconomic. Over the coming decades, climate risk is an existential crisis to the sector. So, as you can imagine, as an investor running money for an insurer, you have that additional focus. So investors should care about it financially. It's not just about being a universal owner, it's also worrying about what are the moral consequences of how people are making money today. Is it at the expense of future generations? And what should they do about that if it is? And at the moment it is. So how do we as owners behave in a way that encourages those companies to transition away from a high carbon future and towards a low carbon future? So there is various reasons why investors are concerned, be it microeconomic or macroeconomic, moral and financial.
What climate related information would you say is useful and valuable to these investors?
I love the way the TCFD and the sustainability standards are framed it under four thematic themes. So these four thematic themes are to do with governance, how organizations have established a committee or governing body that is concerned or oversee the sustainability reporting or things to do with climate change. The strategy in short and medium and long term, how the strategy of different companies incorporate climate risks and opportunities into the long and into the short, medium and long term. Then also how the risk management framework of these different companies integrates the identification and assessment of climate related risks, and also the different metrics and targets which are set by organizations to assess and manage the changes in climate and their impact on climate change.
So, as a professional in this field, what advice would you give to organizations preparing for climate related disclosure?
Um, I would say don't let the perfect be the enemy of the good enough. It is worth reflecting on just how far we've come. Since the launch of the Carbon Disclosure Project back in 2001, thousands of companies have stepped up to improve how they disclose and ultimately manage their environmental data. Because at the end of the day, what gets measured gets managed. And in this space, it matters a lot, not just for businesses, but for people and the planet as a whole. So don't let the pursuit of perfection hold you back. This is complex work, and yes, it can feel overwhelming at times, but progress, even imperfect progress, is what truly moves the needle. So don't let the perfect be the enemy of the good enough.
Thank you so much, Michael, for joining us today.
Thank you, Melissa, for hosting me.
As we conclude today's conversation, one thing is clear: climate change is no longer a distant environmental concern, it is a present and material financial reality. For financial institutions, investors, regulators, and businesses alike, the question is no longer whether climate risk matters, but how well prepared we are to understand, measure, disclose, and respond to it. The institutions that strengthen governance, improve transparency, and integrate climate considerations into strategy today will be the ones that build resilience tomorrow. And importantly, this transition is not only about managing the downside risk, it is about mobilizing capital, unlocking innovation, and positioning our economies, including here in Uganda, to compete in a rapidly evolving global landscape. At Thornton, Uganda, we believe that clarity drives confidence, and conversations like these are part of building that clarity. Thank you for joining us on this episode. If you found the discussion valuable, please subscribe, share it with your colleagues, and continue engaging with us as we explore the issues shaping the future of businesses and finance.